Well, good morning. Good morning. Happy Monday. And today we're going to be talking to Leanne Mitchell from Numbers Count about tax tips as it's nearing the end of June. Hopefully the hard work has been done already. You may have missed the boat, but Leanne's going to pass on the wealth of knowledge, her wealth of knowledge, which will be great. Council and the Canberra District Business Chamber have been bringing you these webinars now for the last 9 weeks, and they've been really well supported. We would like to also send out a survey to people just requesting topics and things that they'd like to cover, and also talk about timing. I do think the webinars will continue because I think people do like to either log on or actually listen to the webinars at another time. At their convenience. So I think it's something that we will continue on with, but I would be really interested to find out if people have a preference for a time and a topic. So without further ado, I'll pass over to Leanne to hear about what's been happening this week in the world of finance.
Thank you, Megan. Yes, it's amazing to think that when we first started these, we were in the middle of the first few weeks of the shutdown of COVID. And I remember the initial discussions you and I had about what we might have been able to offer the business community in Kiama during those really interesting times. And when we think back over those first few weeks, the opportunities and the options for how you could trade, the JobKeeper, the PAYG stimulus, all of those things were very, very new, and they were being thrown at us week by week. And businesses were trying to struggle with what that meant for them on a week-to-week basis. I do remember in frustration, I think in about week 4, I think it was really, really hard from my point of view trying to support and be in support of my clients and those people in my world requiring some sort of financial support, trying to make decisions about what the best options for them were moving forward. But it seems so long ago. We've all achieved so much, made some big decisions in our businesses. I don't think any of our businesses will ever look the same. But it's interesting to just sit back and reminisce. I know I do work with a beautiful woman doing some blogging workshops. And she did say to me on the first week of COVID, she said, "You're in a position where it's really important. You should be writing down every week what the experience is and what's been going on." And I think when I look back, I'm very grateful for the opportunity of being doing these webinars, because I actually think that they're probably a good representation, if you go back from the beginning, the journey of the beginning of COVID and how we all coped and what the changes were during those periods of time. But I've got to say, wow, what an experience. So moving on, I have to say at this point, moving into end of financial year, it's a crazy time. Some people obviously are still in survival mode. Others have thrived and done quite nicely through this period, whether the stimulus was of support for that period or whether they were just able to turn their businesses around. I know I had the opportunity of talking to the team down at Cosbo in Canberra regarding they're doing some support of the federal government, and they're looking for the good news stories and the turnarounds. And it was interesting when I sat there and looked at my client base and thought, now, who's got turnarounds? There were so many of them. But the fabulous thing was that I had to pick a few. So it was interesting to see which clients those were that I was able to pick up and turn around. Obviously they're looking at, and Scott Morrison's team are obviously looking at, if we go through something similar to this again, what did work and what didn't work. So if you're listening to this and you've got any key issues that you'd like to raise with me and I can send to them, please do contact me either via email or contact me via Megan to let me know what you would like me to take to them to discuss. It's a wonderful opportunity that I've been given to share our regional experience during that time. So on that, today, my main aims for today actually were to go through the cash flow boost, which will come through on the BASs for the 30 June BASs. I just want to go through what that's going to look like. A quick look at the JobKeeper and what the tax office is looking at, because they have started audit activity and started looking. JobKeeper declarations, obviously, for June. And there's an annual wage review decision 2020, which was really interesting and great, some great reading, which I won't bore you all with, but I'll give you a quick rundown of what that looks like. And obviously then just some year-end tax planning. And on that too, if you'd like to get onto Numbers Count newsletter, please just contact the office or contact Megan, and we can get you onto that newsletter, because there's some really good stuff that comes out. During COVID, we were doing it weekly and fortnightly, but I think we'll slip back to monthly. Just an update as to what's going on and what you need to be careful for and look out for. So the PAYG, which all employers who declare wages on their quarterly or monthly bases received somewhere between $10,000 and $50,000 PAYG credit on their March bases. The second tranche of that is coming up, and those employees will be eligible again from the 1st of July when they lodge their bases. As with the first one, it is only an additional amount that's added to your BAS, and it will either come off your BAS, or if it exceeds the rest of your BAS, then that money will be refunded to you. And in light of the manner in which the tax office held up their end of the bargain in March, they did refund it. Even if you have old outstanding debts, they did actually refund you those differences. In a news notice that the ATO published this week, that they explained that the additional amount will be equal to the total initial cash flow boost received by the business, and will be split evenly, so 50-50 over the June quarter and the September quarter. So if you receive the $10,000 in your March BAS, you will anticipate receiving $5,000 in your June credit off your June BAS, and then $5,000 credit off your September BAS. The ATO has cautioned, but I think we would all be aware, if you've revised your activity statements for whatever reason, that will hold up them giving you back your cash flow boost, because those will all be reviewed. And the tax office has advised employers that haven't made payments to employees subject to withholding, but did actually pay amounts of money during that period, to make sure they lodge their activity statement with a 0 on it, and they will still, by all accounts, be eligible for their additional cash flow boost, which is incredibly interesting given that JobKeeper has been in the system, and so that would obviously be for employees that you withhold that are non-eligible and you're not withholding any tax from, which in a lot of the smaller businesses would possibly be a case. And it's also noteworthy that I read somewhere else, and obviously a good reminder, do not deregister from PAYG withholding on your BASs until you receive all of those additional cash flow boosts. So even though you may lodge your BASs with a 0 PAYG credit, make sure that you do it. Make sure that even if it's a 0 wage, that you actually put that through. It's interesting because I thought this is noteworthy given all of the ups and downs over the amount of money that Scott Morrison's team paid in JobKeeper, or anticipating paying in JobKeeper, that the ATO has applied $13.38 billion in cash flow boost credits to 708,000 businesses. Now, the interesting thing about this PAYG credit system is that every business got it. Whether you actually suffered with a downturn or you didn't suffer with a downturn, you still got it. So you did not have to be eligible for JobKeeper. There had to be no proof of downturn. Every business that employed individuals on wages received some form of this PAYG credit. So, and they've definitely confirmed that the June 50% will go through. No rush to get your BAS in, because it'll just offset your BAS payments. But if you're anticipating your $10,000 credit refund, then obviously sooner rather than later. But whilst we haven't been given a date, I would assume that in line with what the March offering was, that those credits don't tend to get applied until the 3rd or 4th week in July. But still definitely proving that they're coming through. Now with JobKeeper, we've in our office seen a little bit of activity around the whole JobKeeper review by the tax office. So there's definitely, and it appears to me that they're picking particular industries which they didn't feel should have been affected, but that doesn't mean that they weren't. And once validly proven, the tax office were quite happy to put that money through. And the ATO, with their poor use of words, for businesses regarding fraudulently seeking the JobKeeper payment as part of an effort to maintain the integrity of the stimulus measure, which is interesting, but the tax office can never quite help themselves with this. So they're, the businesses that they're actually looking at and reviewing particular activities, payments to people who did not meet the eligibility and requirements, who are not actually employees, falsifying records or revising activities statements to meet the fall in turnover test. I don't know that that is relevant. I think anybody that thought that they were going to get away with that was playing a game with themselves. Applying for JobKeeper where there's no evidence of carrying on a business, or is there no accessible income from carrying on a business? Now, this is particularly in the sole trader arena, which they highlighted in the beginning that they were concerned that people, just because you had an ABN, would think that that made you eligible to actually get the JobKeeper. So that review activity will go on for a little while, because obviously they're going to wait until you lodge your 2020 tax returns and make sure that you actually had some income in that year prior to the downturn of COVID. And that will be a really interesting scenario to watch roll out in the future. In addition, employers failing to pass on the $1,500 JobKeeper payments to eligible employees. I know I've had a few people ring me about their concerns with employers. I think it's just a misunderstanding. The employers seem to play the game when they're forced to. Multiple eligible business participant claims. You are only entitled to receive it once from one business, from one employer. You cannot claim it multiply. Now, the ATO are going to see that when you lodge your tax return. So hopefully, if you have fallen foul of that, it's probably a good time to step up and have that corrected before we get to 30 June. Employees being incorrectly excluded under the one-in, all-in rule, which I know was a difficulty that I had in the early days. When you talk about some frustrating periods in those early days, that was one for me. That obviously was cash flow tactically very difficult for bigger businesses that had a lot of casuals that were included in that all-in JobKeeper arrangement. But we were all able to work our way around that, thankfully. And making false claims and not complying with the obligation. So all of those things. But they're basically, if you've done the right thing and given the right information, then I don't see that there's any concern that you need to have regarding that. The ATO will focus its attention on the application of the decline in turnover test, including examining situations where actual and projected turnover have significantly diverged, after they told us that they weren't going to do that. But this is the tax office and they cannot help themselves. So I know I had clients saying, oh, but at the end of the day, they were always going to have a look. So if you do have the ATO breathing down your neck at some point about that and you're concerned about it, please talk to your accountant, and by all means give our office a call, and I'll do what I can to support you in that. They've in their words, we encourage all JobKeeper applicants to review their applications and contact us if they have made any errors or an honest mistake. We have a limited discretion in relation to overpayments where we can exercise in certain circumstances. So let's see where that's available. If you have any questions about workplace entitlements and obligations in the payment scheme, the Fair Work Commission have released guidance on how it can assist. Now, it's been very, very busy and really ridden under the radar. There hasn't been a lot of discussion about the Fair Work Commission, but there's certainly a lot going on in the background regarding what they're up to in businesses that have had to actually put employees off or made different decisions over this period of the JobKeeper. So I don't think that's we'll read a lot more about that, I think, in ensuing periods. Now, treatment of JobKeeper. If you're an employee receiving it from your employer, obviously it will be added to your ordinary income and it will be on your PAYG statement at the end of the year via MyGov. For sole traders, that money will have to be included in your assessable income and the tax office will go looking for it. I note at this point, having looked at the early versions of the 2020 lodgement, it's not actually categorising it as a separate payment, but I suspect that that may change in the very soon future, because that would be the easiest way for the tax office to monitor what other activities you as a sole trader have been up to. So that's sort of where I'm at regarding the JobKeeper and stimulus at this point, for so far into this 2020 period. I know for a lot of businesses have the most common question is, well, we no longer feel like we're entitled to it because businesses turned around. That wasn't the purpose of JobKeeper. Once you qualified for JobKeeper with a 30% downturn at any point in April, May or June, you qualify and you stay on till the end of September. My only concern around that, and I will mention it because I'll keep harping on it, please make sure that if you've been receiving JobKeeper for your staff, that you have a cash flow plan of how you're going to manage that moving into October this year. Because I think it could be very painful and hurtful for a lot of businesses if you're not sorted as to how you're going to find that money in your cash flow. A lot of my clients are already reviewing and putting money aside to make sure that they have that. But please, if you haven't considered it, make sure that you do have a look at it. And we might actually do a session of that in early July, maybe, Megan, where we'll focus on what that's going to look like for different businesses in different industries.
Leanne, I've just got a question for you. Do you have any knowledge of the new grant brought out by the New South Wales government? It's called a recovery grant. It's a $3,000 grant.
That's right. There's still nothing. It's coming up on the website. It's not available until the 1st of July, I believe.
Yep.
And it is meant to be for marketing and rebuilding businesses. It was an interesting, the upfront commentary on that grant, but let's see what the outflow of that is on the 1st of July. We actually get to see that payment. So because the initial $10,000 grant, which was only going to be available for a short period, has been extended to the 30th of June. So for those people who haven't yet gone in and claimed that, now would be a good time to get that in, because obviously you've only got a week. Probably the disappointing thing in that grant is there are still people who haven't actually received it, which is unfortunate, but I know that they are processing those applications as quickly as they can and getting them across to people as quickly as they can. So I know for my clients, it's only really started to come in the last 2 or 3 weeks. So they are very much behind the 8 ball. But with all of these stimulus and processes, they obviously were new. They had to create them and find staff from somewhere and train them up onto what they needed to do. So, and we'll wait and see what that $3,000 grant, obviously they'll wait until the $10,000 closes and move on from there.
Okay.
So if we have finished about that, I'll move on to our year-end tax planning, which is always a bit exciting, and for some people obviously just a difficult period where they sit and go, what are we going to plan around? We've got nothing. So, but surprisingly, some businesses have actually come through this very nicely, and people who thought that they wouldn't get JobKeeper, that they might have got JobKeeper didn't. And a lot of that is really the fact that people worked very, very hard to turn their businesses around and pirouette into a different style of business. But I will admit, most people that was very labour intensive, so they didn't do the drop, but they certainly were able to put their mind and their hands to getting their business into a different framework, which does mean for a fair few of my clients that they won't go back to doing their business the way they did previously. There'll be a whole new way of looking at the way they run their businesses. So 2021's looking like it's going to be a more than interesting year after the challenges of 2020. And there's a lot of excitement around, given that we weren't shut down for as long as we were potentially all considered that it could have been, or potentially could have been. So let's hope that this breakout in Victoria doesn't flow through into New South Wales, although obviously at the keeping of the borders closed for Queensland and WA could and maybe does have effects on some of our businesses, but on the community, the economy as a whole. All right, just a second. Lots of talking. So for the end of financial year 2020, I've just split up the tax planning into two separate areas. So I'll go through the individuals first because that's applicable to everybody. Reminding everybody that you are still, no matter whether you're employed or not, you still have a concessional contribution cap of $25,000, which means that you can, each individual can tax deduct $25,000 worth of contributions into super. Now that does include what's been held by your employer. So just making sure that if you're going to top up that contribution to $25,000, that you have considered what your employer has put away on your behalf, and make sure that you notify your superannuation fund of your intention to claim. We had a few reviews this year based on where those intentions to claim had not been lodged with the super fund, because of course they notify on the back end back to the tax office to know that your contribution has been correctly treated by both the superannuation fund and in your personal tax return. The other thing that was initiated in 2018-19 was the ability to go back and top up, so that in this year, if you didn't take your entire $25,000 in 2018-19, so the last financial year, you can top up this year for the difference from last year. So if you had not as good a year in business, if you're a sole trader, or even as an employer where you didn't have the available cash flow, if you found the PAYG credit, it's right up your alley and supported you, then maybe you might consider topping up to your $25,000 from that was left over from last year, and that will go into this financial year, and you can claim a tax deduction for that as well. So that's worthwhile considering, and not obviously an option for everybody, but certainly a possibility. Now that carry forward again will exist then again for next year. So if you miss it this year because you just don't have the cash flow, be conscious that you can catch up this year into next year if that's a possibility. Especially if you're getting close to retirement, please don't miss those opportunities to get it in, because $25,000 is a very limiting factor when you're getting closer to retirement age. The other point I'll make here is the downsizing contributions capacity. So this year you were allowed, if you were aged 65 years or over, and you can make a contribution into your superannuation of up to $300,000 from the sale of your main residence. Now, it's not a tax deduction, but it can go into your super fund, at which case you can start to draw off that as a pension, and it can start to build within the asset base of your superannuation fund, at which case it tops up your capacity for your pension and gives you a longer, stronger period during that phase of your retirement. So I would suggest for everybody not to take that lightly though, and to get some advice as to your personal situation of that. The eligibility rules for that are simple. It must have been your main residence, and it must have been for 10 years. And the contribution exempt from the age test, the work test, and the $1.6 million total superannuation test. So, which is interesting because I think that's about the only one you're allowed to do that for. The first homeowners super saver scheme, voluntary contributions up to $15,000 can be made into your super fund for a deposit for your first home. When the time comes to buy, you'll be able to withdraw the contribution plus any of the earnings on that money, whatever percentage that is, and that'll be reported by your super fund. Voluntary contributions made after 1 July 2018 may also be used for withdrawal under this scheme. So even if you're making voluntary contributions as salary sacrifice through your employer. The other thing is that for those working who can contribute superannuation for their spouse, you are eligible for a $540 tax offset for after-tax contributions up to $3,000 to a complying super fund for your or on behalf of your spouse if their annual taxable income is less than $40,000. Now, again, with all of these, any of these contributions need to be made before 30 June. Now, I would suggest that you have them in by mid at worst late this week, because if they don't get processed in time, you do not get the tax deduction. Now, the other thing that has been in the system for years and still people forget about it and don't make the most of it is the superannuation government co-contribution. Now, this is really particularly relevant, I think, to the younger, those just starting out work or have a half year, or women who are getting closer and closer to the potential of retiring. Is that if you earn less than $52,697 and make an after-tax contribution of up to $1,000 to your super fund, the government will match that contribution at the rate of 50 cents in the dollar. So if you put in $1,000 after tax, they'll add $500 to that. And whilst it's not a large sum of money, it's a 50% return in your first year, and you don't see that very often in your super fund. Again, those contributions will need to be made by 30 June. In superannuation, was it? Yeah, I think that's the main thing. But don't forget, you can actually salary sacrifice out of your wage into superannuation too, and it doesn't need to be a large sum of money, but it is a nice way to top up your superannuation balance each year, and that doesn't matter what age you are. I think the sooner that you get that in there. I do speak to a lot of the younger clients who sit there and go, no, I'm retiring 55, I'm out, I'm done. I sort of think, oh yeah, I probably used to think that too, but you know, then you get there and think, oh, I haven't quite got enough and things didn't quite go, but I really want that holiday and do a few more things. So here we are, still kicking on. So the other, so obviously superannuation is a great way to tax deduct and get that money into superannuation, because superannuation fund, majoritively, other than the high-end income earners, is still only taxed at 15% and has the potential of growth and year on growth. So the sooner you get that in there, obviously, the better the return is. The other thing in looking at, but it is concerned with cash flow, is the ability to prepay tax deductible expenses. So if you're claiming your motor vehicle for work, you can prepay your lease expenses on your work vehicle. Also, you can prepay your interest on your negative geared property and double that up for a year, but make sure you have that conversation with your bank and make them aware that that's what you will be doing. And that's a worthwhile tax deduction. That can be very useful when you know that next year's income isn't going to quite be the same as this year's. And this year, whilst I may be telling you that might not be the year, but be conscious of that that's available to you every year and has been always available. The other things that I really wanted to note more on a business front than the individuals, again, prepay any tax deductible expenses. If you've got some excess cash flow, to minimise your having to pay tax, I suggest to my clients, pay many of your July and August expenses that you already have up front, remembering that the majority of the clients we talk to are cash lodgers, which means that you pay income tax based on your actual receipt of sales revenue and your actual payment, so it doesn't include your creditors' payments, but actually where you've actually paid for those expenses. So the point being that in June is to try and pay as much as we can to reduce the potential that of paying that tax. And given if we're paying July expenses, all we're actually doing is bringing forward the payment. We would still have to make it in July anyway. For those operating through discretionary trusts, make sure that you've actually done your distribution resolutions for this financial year. They must be done and committed prior to 30 June. And often that's really a tricky decision as to how you're going to do that distribution. But I think this year, given how proactive we've all had to be with getting our financials done month by month, I know certainly here, to do the JobKeeper payments and know what our income is each year, even for those people on borderline of getting JobKeeper, we've been very up to date. So I think people are more aware this year, more than ever, of what their income's going to look like. And it is a reason to get in the habit of doing it every year. It's nice to be empowered and to know exactly where the profit and loss position of your business is, especially when we're coming up to the end of financial year, because you're wanting to make decisions that will maximise the tax benefits. And for most things, because you're a cash lodger, have to be done and paid by the 30th of June. You don't get to go to the accountant in July or August and go, can't you just fix that? Some things are just gone, and if you don't get them in by 30 June, they're lost. And on that basis too, and again, this wouldn't be relevant for a lot, but remembering that we are able to claim straight out tax deductions for pieces of machinery or equipment purchased into our businesses for up to 150,000 per asset. Now, it may not be relevant, that's a big number, but also remember, if there's a piece of equipment that you really need in your business and you can afford to go out and pay for it now, and it would make your business more efficient in the ensuing year, have a look at the possibility of making that an opportunity, because it is very relevant. Again, affected by cash flow and affected by how quickly your business and how your business is coping through and on the other side of COVID. For those running in small companies, just please make sure that you repay all of your directors' loans, because again, during this COVID time, we were a little, I think, not as astute or not as careful in our planning of how we were paying wages to our directors and nominated staff that are related. So just be careful that you've cleared up any of those outstanding loan accounts. We don't want any of those awful Division 7 issues. Make sure that your relevant motor vehicles have logbooks all sorted. And if you're using the logbook operating method for fringe benefits tax too. There's always the usual about having a look at your depreciation schedule on your business, but I would think for most businesses and over the last few years with those thresholds, most people are writing off nearly any asset they buy in the year that they buy it. So two last things for everybody is, if you are eligible for the $10,000 New South Wales small business grant and you thought it was too hard, please don't make the contact, get yourself registered and get that. They are talking people through, helping you get there. So if you're concerned, just get the application in, and as long as it's in before 30 June, you're in the process and the possibility of getting that $10,000. The other thing is, if you've been working from home, make sure that you have recorded those hours, because whether you're a company or an individual, those hours are available to claim as a tax deduction. Now, the tax office have written a great little piece and set up a standard rate for those. Yeah, it's called the shortcut method. And you can claim a deduction of 80 cents for each hour that you work from home from the 1st of March to 30 June. As long as you're working from home to fulfill your employment duties is the qualification, and have incurred additional running expenses as a result of working from home. So the shortcut method covers off on electricity for heating and cooling, running electronic items, your computer, decline in repair and capital items and home office furniture that cost less than $300, cleaning expenses, your phone expenses, your internet, your computer consumables, and the decline in any value. Now, if you believe that that rate is too low for you, you still have the option to use the actual method, which is how you would claim for any period outside of their 1st March to 30 June period. And if you have concerns around how you would make that and optimize it, please call your accountant or have a look. we've detailed that fairly clearly in last week's newsletter if you'd like to get a hold of it.
What about, sorry, Leanne, just a question. What about, have they made any allowances for the fact that children or, you know, like your kids have had to come home and they might be working from your home as well? Is that, have they made any allowances regarding that?
No, none. So yeah, that's a whole tricky, really, when we think back about those periods and those poor people who are at home trying to work and trying to educate their children at the same time, and supplying all of those expenses and those computers, because obviously for some, if you're using the home computer, then the kids can't use it, and you've had to buy additional equipment or engage the old iPads and all of the other pieces of electronic equipment. So no, that hasn't been considered, but certainly worthwhile considering and talking to your accountant about whether there's a way to get that. But what is particularly relevant to the children's education is not claimable, and no provision was made to enable that. Actually, no discussion has been made about the value add of that either.
You know, I was thinking more about adult children, like uni students or, you know, people that were living in the cities that had to go home or had to move back home, yeah, out of the city or something like that. So
yes, no, nothing. You know, if they've stuck to the old Section 51 deductible expenses, they must be specifically related to work that you were paid for. So, and students don't get caught under that. So it was a little bit tricky for, I think parents did out, even with the whole job seeker and those things as well, which was a little bit tricky. But I think they're probably my major discussion points today, without going too in discussion with it. But, you know, as we wind out this period and wind out the financial year, I really want to congratulate all of those businesses that actually saw it through. Some of that was really, really hard, but I felt myself that the community really held together in this period, and I've experienced in the past that has not always been the case. So I'm really proud to have been part of this community during this really difficult time, and to see how people work together for the betterment of all of us, not individually. I think that's been such an empowering time, and yeah, really congratulations to all those people, because some of that was just darn hard work and showed the true Aussie entrepreneurial spirit, I have to say, which I was really pleased and proud to be part of. But thank you again, Megan, for having me, and I've really quite enjoyed the ability to interact with the local community and add value. So I look forward to seeing you next week, and thank you again. Wish everybody all the best for the end of the 30 June financial year. I think we will be getting together for one last catch up end of financial year next week, but I would please make as many decisions about end of financial year this week and get them done. We do run out of time very, very quickly, and since 30 June is Tuesday next week, yeah, I would don't leave things till the last minute. And good luck with it all, and please, if you've got any questions or we can be of any support, please give the office a call. And thank you for listening in. See you again. Bye.
Thanks so much for that, Leanne. Amazingly simplified system, although I know it's not that easy. You've clarified a lot of things for me, and interestingly, you mentioned about those particular businesses that have pivoted and changed and really looked at their business models as so critical during this time. We are having a webinar on Wednesday titled Creating Freedom Through Systems. So it's all about trying to make your life easier by implementing digital technology in your business. So that one will be a great session. That's Wednesday at midday, again with the guys from Resolve Business Coaching. Yeah, so thanks again for joining us. And Leanne, thanks again. And on behalf of Kiama Council and the Kiama District Business Chamber, thanks for joining us.
Thank you, Megan. Bye.
Bye.